This show is going to be about the $1 trillion in negative yielding corporate debt. What does that mean? What red flags should potential investors watch out for in their research? And also an alarming trend, and I'm going to show you what the corporations are doing, or I'm going to tell you, rather. I'm not going to use a bunch of slides. You can go look this up if you want to do a additional research project, what the corporations are doing with earnings per share, with the PE ratios to hide how much debt. And also the ratings agencies are involved. There's a problem with corporate governance. There's a lot of different factors involved. But these large corporations, since central banks have gone to zero interest rate policy, financial repression, even negative interest rate policy, or NIRP, these corporations, the executives running them, have taken advantage. Some of these shares have gone up a lot, but there are a lot of warning signs, a lot of red flags for a lot of these large corporations. And just because there's a 3% dividend yield, just because it looks like the company, these large corporations, are earning a good earnings per share, does not mean there are not a lot of red flags for these large corporations, and the average retail investor should not avoid them. Okay, so I think I'll start with this Jim Bianco article. This chart is from an interview that Jim Bianco did. He's a global macro researcher. He's very well respected. Normally he tracks bonds and global macro. Recently he started seeing very positive comments about gold. But on Wednesday, August 21st, CNBC published an interview with Jim Bianco saying the surge in corporate debt with negative yields poses the risk unlike anything investors have ever seen. The negative yielding corporate debt recently passed the $1 trillion in market value. Investors holding the bonds for price appreciation face significant risk should rates start to rise, says Jim Bianco of Bianco Research. Quote, the financial system doesn't work with negative rates. If the economy recovers, the losses that investors would take are unlike anything that they've ever seen, he says. I don't think the economy is going to recover, but if rates do go up, he has a point. Government bonds aren't the only instruments producing negative yields these days, with corporate debt recently passing the $1 trillion mark in a continuing sign of global financial displacement. Investors these days are facing huge amounts of fixed income instruments that carry no yield. Various estimates of sovereign debt in that category put the total in excess of 15 trillion. I think it's over 16 trillion, almost 17 now, a number that has been escalating over the past several years, while central banks drive interest rates to zero and below. Negative yielding corporate debt, though, is a relatively new thing, rising from just $20 billion in January of 2019 to pass the $1 trillion mark recently, according to Jim Bianco, founder of Bianco Research. The graph the chart that you guys see is from Bianco Research. The trend poses a potentially dangerous threat, especially if market winds shift and bondholders looking for price gains rather than yield get stuck holding too much risk. Quote, the interest rate risk that these bonds carry is huge, Bianco said in a recent interview. The financial system doesn't work with negative rates. If the economy recovers, the losses that investors would take are unlike anything they've ever seen. Negative yields have been confined to places outside the U.S., though some Federal Reserve officials have toyed with the idea, at least in a hypothetical sense. Former Federal Reserve Chairman Alan Greenspan recently joined some investors when he said there was nothing actually standing in the way of negative U.S. rates. And then Greenspan has done additional interviews after this one came out, because this was on August 21st. He's done additional interviews just in the last week or so, saying that negative rates in the U.S. are only a matter of time. So most of the negative yielding corporate debt is in Switzerland, while some also is in Japan, Bianco said. Investors don't actually pay to borrow money, but the negative yield is symbolic of how much above par investors are willing to pay for these bonds. Also, the nominal yield on the bonds, the face value of the bonds, is below the real inflation rate each government is officially saying. So that's because those who buy negative yielding bonds are essentially making a bet that rates will stay low and prices will rise, which is the traditional relationship when it comes to fixed income. Should rates start to rise even a little, that will start to eat into the capital appreciation that bondholders have been enjoying. For instance, Bianco said if yields on Swiss bonds go up just 2 percentage points, it would amount to a 50% loss for bondholders. For the corporate bondholders. While some individual investors might be able to absorb such losses, they would be catastrophic for institutions. A wall of new money. On the sovereign side, Germany is the starkest example of negative rates, with yields all along the curve there trading below zero. And let me see if there's any more here about the corporate debt, about the article here. I read it a while ago when it came out. Let me see if there's anything else on corporate debt. So of all global investment grade debt delivering any yield, 95% is from the US, according to a researcher. Non-financial business debt was at 6.4 trillion at the end of the first quarter of 2019, a 73% increase from mid-2009 when the current expansion began. However, a portion of equities, it's only 33.7% from the postseason peak of 69% in early 2009. Covenant protections or buffers, or the buffers investors demand in case of default, are at record lows, according to Moody's Investor Service. However, default rates are projected to remain low. I disagree with that. The covenant protections, the covenants are so laxed. The debt covenants for so many of these large corporations are so laxed, they don't even use the normal debt to equity ratios anymore. If you run a stock screener, guys, on like CNBC for free, they don't even have normal debt to equity ratio anymore. It's just in the financial strength category, it's just a long-term debt to equity. So they're not, because the debt to equity ratio, the regular debt to equity ratio, which if you're not familiar with it, if you go to Investopedia, the definition is total liabilities divided by shareholder equity. And that's your debt to equity ratio. And those debt to equity ratios, some of them are just atrocious. They're way above 1. Yeah. Total liabilities divided by total shareholder equity. They don't even use for debt covenants, guys. They don't even really use those anymore. A lot of these debt covenants are so laxed for these large corporations. The debt covenants now are debt to EBITDA, earnings before interest, taxes, depreciation, and amortization, which is not even real earnings. So these corporations are allowed to, basically the bar just keeps getting lowered and they can easily jump over it. And then these corporations are able to borrow cheaply because these central banks are manipulating interest rates lower or issue more debt. And then the corporations, there's what the CEOs and the executives are doing is they play games to manipulate earnings per share. And I'll talk about that in a second, but there's problems with corporate governance. There's enormous problems with corporate governance. There's enormous problems with the incentive structure. The incentive structure with the corporate governance should be put in place so these executives are only given bonuses or stock options if they create new products or service, create more value long term, but that's the exact opposite of what's happening. Basically, if they beat earnings and the earnings are financially engineered, if they beat earnings every quarter, these guys can get rich in 2 years while drastically changing the balance sheet of the corporation in a short amount of time. The debt to equity ratios, guys, can just get into enormous trouble. So you have a situation, and on top of that, then if the company gets into, and then the ratings agencies won't downgrade, that's why you have 40% of all corporate debt, which is the amount of corporate debt in the US has exploded. I think it's around 11 or 12 trillion, something like that. It might be 13 trillion now. And there's an enormous over 3 trillion in junk bond debt now here in the US. And on top of that, once a corporation, a large corporation, starts playing with enormous amounts of debt on the balance sheet, then you get into a situation where any drop in revenues or any compression in margin and the corporation is in big, big trouble. And that's how you can get into a situation like General Electric or Campbell Soup or some of the other companies that have had a lot of problems. Campbell Soup was going through a pretty big restructuring. Right now, Campbell Soup's market cap is a little above $13 billion. Their PE ratio, guys, is at 64, and they have a 3.14% dividend yield. But and their stock has rallied, I think, a lot year to date. It was at 32 on January 2nd, $32.26 on January 2nd, 2019, and the stock is at $44.98 now. So it's had a pretty big rally, but there's a lot of red flags with Campbell Soup. I looked through their SEC filings, and their real debt to equity ratio is astronomically high. So there's been value investors there, like Dan Loeb, I think, and some of the other, Seth Klarman maybe, either Dan Loeb or Klarman, I forget, who have tried to get on the board of directors, activist investors, and restructure the company, sell off assets. But Campbell Soup has not grown revenues at all in the last 3 years. So this is a no revenue growth company. In fact, the revenues fall some years. This is a no revenue growth company that's selling for 64 times earnings with a 3% dividend yield. Let me take a look at their financial statements here. I have their SEC filings up. So their total current liabilities is 3.5 billion, and their total shareholders equity is only 1.228 billion. So guys, that's almost a 3-to-1 debt to equity ratio. If you do, but I bet their debt to EBITDA ratio looks a lot better. Okay, so Campbell Soup, the big red flags there. There's a lot of other corporations like this. I went back into the SEC filings and I looked at ExxonMobil. And ExxonMobil is in a very cyclical business because of the oil price. The oil price can be very volatile, can swing very volatile. And I went back and looked at ExxonMobil's balance sheet in 2003. This is from their 2003. Because I wanted to see if their balance sheet was any less leveraged. And their debt to equity ratio back then was still around 100%. So 1-to-1. Their total liabilities back then in 2003 for ExxonMobil. This is the third quarter, end of the third quarter, September 30th, 2003. They had 83 billion in total liabilities, 83.223 billion in total liabilities, and 83,764 million in total shareholders equity. And if you go and look at the debt to equity ratio for ExxonMobil, it's a little bit below that, so it's a little bit below 100% now. And with mining companies and oil and natural gas producers, it's a very cyclical business, and it's very dangerous to have very high debt to equity ratios because your revenues are not predictable, especially if you're not hedging your commodity prices. So all of a sudden what could happen is the commodity price, like what has happened in the oil market, where it was $17 6 or 7 months ago, and now it went down to the low 50s, and all of a sudden your revenues are down a lot and you're still stuck with the debt. I took a look too in the SEC filings at GE's statements, their most recent quarter, and GE stuff is an enormous mess. First of all, the stuff that they put out on June 30th, 2019 for their financial statements and balance sheets, it says in there in parenthesis that all their consolidated financial statements are unaudited. It's like all of the stuff is unaudited here, and the debt to equity ratios look like a big mess to me. And if you take a look at the work of Francine McKenna, I've interviewed her last year. She has the website theauditors.com, and she also is a columnist. She's a accounting professor here in Washington D.C. And she has articles coming out about accounting fraud and bad accounting controls. Even Disney, there was a Disney whistleblower towards the end of August that the stories came out. The Disney whistleblower told the SEC that Disney's been inflating their revenue for years. And that's because of a number of factors, because Disney does use debt. They leverage their balance sheet with debt, and that's how they grow earnings. So if revenues don't grow, or if revenues are lower than expected, the stock could take a big hit. And then also the corporate executives, they don't get their bonuses, they don't get their stock options if the revenues aren't in line. Just a lot of craziness these days. So the PE ratio, guys, the price to earnings ratio, it often hides a lot of these things. The average analyst is not going to go back and compare debt to equity ratios. The credit ratings agencies, it seems, don't even really care about debt to equity ratios anymore, because that's not one of the main parts of the debt covenant. The ratios now that are used are not even really, that I've read through, even for mining companies and others, are debt to EBITDA, another one similar to that. So they're not even using debt to free cash flow or debt to equity. Yeah, I just found out, aggregator, that GE is involved in the Australian real estate and housing bubble too. Pretty crazy, huh? So let me talk about another company here, Kellogg's. Kellogg's has a 3.63% dividend yield, and they don't have any revenue growth. Their revenue drops a little bit, rises a little bit, stays pretty much in a line the last 3 or 4 years. And Kellogg's has, guess what Kellogg's price to earnings ratio is? It's almost 26. So that's symbol K, as in Kellogg. That doesn't look like a bargain either. You would just look at the PE ratio and say that that's not too bad. But I guarantee if you took a look at the balance sheet, if you went back and looked at their financial statements and how their balance sheet has changed in the last 10 or 20 years, you would see that the amount, the debt to equity ratios have gotten crazy. Trillions. This is a good super chat question, a very good one from Lorky. How much money has been spent on share buybacks since 2000? Was it from... The amount of share buybacks was high from 2000 to 2008. I don't know the exact number. It was probably about a couple trillion, but there's been trillions more in a shorter amount of time. The share buybacks were a lot in the past, but the companies were not able to borrow as cheaply in the past. They had more free cash flow back then. I think what the companies are doing now, guys, to maintain their margins is they're intentionally, and Netflix is a victim of this too. Netflix has been purchasing their content or locking up their content with a massive amount of debt. So that's why Netflix has to keep raising prices. So that's why you're seeing Netflix constantly raising prices by $1. And it's not because they're stupid or greedy or evil. It's because Netflix has that much debt. And unless they want to massively dilute their shares, the only way that they can pay the debt back now is to keep raising prices. And Netflix, the problem with Netflix, with the leveraged balance sheet, is they have a very high valuation. And if they don't have subscriber growth, then the market starts to get worried. So no one cared that Netflix was using that much debt until the subscriber growth started to slow down. The share buybacks, I think I saw somewhere that someone was running the numbers, and the share buybacks since 2008 are $5 trillion. I think it's $5 trillion. Lululemon is one of the top market leading consumer stocks. I would watch that stock. If the stock starts to break down, that'll be a warning flag that a stock market crash is coming. I would watch that stock. I ran a stock screener from CNBC. You can do it for free. I can put a link to it. It's cnbc.com/stock-screener. And I was looking through large cap S&P 500 companies with a market cap greater than $5 billion. And I was looking for debt to long-term debt to equity ratios, because they don't even have regular debt to equity ratios, of 1. So that means 100%. That means the debt to equity ratio is at least 1-to-1. Or higher. So there's either the company has an equal amount of long-term debt to equity or more long-term debt than equity. And there was, according to this, there was 440 matches out of the 500 S&P 500 companies, S&P members. I'll read you some of the names. You have 3M. You have the ones that you know: Altria Group, Archer Daniels Midland, AT&T, Baker Hughes, BB&T Bank, Best Buy, BlackRock, Bristol Myers Squibb, Broadcom, Campbell Soup, which I talked about. Campbell Soup, guys, that debt to equity ratio is real bad. So they're going to have to, and that's also because the consumer is just not consuming as much soup. It's just not as popular. So a lot of those soup companies, I used to have a lot of canned soup a long time ago. It's a salt bomb, but they've taken a lot of the meat out of the soup. It's mostly just a few vegetables now, some broth, and a couple and noodles or rice. So they've taken a lot of the meat out of the soup, and that's shrinkflation. So shrinkflation, raising prices. This is how a company deals with margin compression and too much debt to try to appease Wall Street too. So it's not just the central banks that are putting monetary inflation into the system. These corporations are also rapidly doing the shrinkflation too to try to survive, so the executives don't get fired. And a lot of it has to do with the debt, because once a corporation goes to a lot of debt on their debt ratios, then They don't have as much flexibility. And this is why you have these large corporations harassing the credit rating agencies to not downgrade them from triple B lower, because they know if there is a downgrade, it's over. They know that this will start to cause exactly what happens with General Electric. Whether or not General Electric did that amount of fraud, Francine McKenna, I interviewed her last year, and she was talking about General Electric. And General Electric has been fined. It was disclosed in the fine print of all their SEC documents and elsewhere and their annual reports. General Electric has been fined by the SEC for many years for accounting irregularities and basically accounting fraud, different degrees of it. So let me go through the list here of some of these other companies in here. Campbell Soup, Broadcom, Campbell Soup, Cardinal Health, Carnival Corporation, which is, I think, the cruise ships, Allergan, Allstate Insurance, Alliant Energy, Altria Group, Amazon. Even Amazon's debt to equity ratio not good. Let's see here. American Express, Ameriprise Financial. I used to work for Ameriprise. Amgen, Ameritech. You know, there's tons of these. Archer Daniels Midland, Applied Materials, Apple, even Apple now, guys, because they've been using debt on their balance sheet. Even Apple has long-term debt to equity problems now. Just a long list. I could send you the stock screener in the information and description section. So, the more intervention by central banks, these large corporations have been taking advantage of this. So the executives can fake earnings, can financially engineer higher earnings without revenue growth, without new products and services, or with bad leverage buyout acquisitions, and then the share buybacks with debt. And so these large corporations, because of central bank intervention, maybe it's an unintended consequence, maybe it's not, and they've just been given more and more rope to hang themselves with. And by more rope, I mean more debt, more credit. So then they just keep borrowing and borrowing and borrowing. And then this is a situation where, like with General Electric, where Jeff Immelt, the last CEO, he did an immense amount of damage. From what I've heard, a lot of the problems started with Jack Welch, but GE had so much asset and cash flow and everyone respected them that hardly anyone was paying attention to the problems with GE back with Jack Welch. But under Jeff Immelt, then the financial engineering just went crazy. Absolutely crazy with the financial engineering. It got to a point where, if you remember the articles from, I believe, 2009 or 10, when Zero Hedge was first starting, one of their stories they were talking about was how General Electric had such an army of lobbyists, tax accountants, tax attorneys, that General Electric actually paid no corporate taxes and was actually getting billions of dollars in rebates. Plus, they were getting government contracts. And look where General Electric is now, all the trouble they're in with their balance sheet, with potential accounting fraud and insurance fraud, although they've been fined for accounting fraud different years by the SEC, according to Francine McKenna and other people who have been researching this, but this is like egregious levels of accounting fraud. Confluence of factors here. The corporate CEOs, and they've made the wealth gap worse because the corporate CEOs are grossly overpaying themselves. But this is a corporate governance problem. If people who are board of directors and shareholders voted on this and fixed this, they could do it, but no one's actually has the backbone to do it. What should happen, in my opinion, to fix this is the CEOs, the corporate executives, should be aligned with creating new products and services. So it should be long-term. It should be not loading the company's balance sheet with debt, focusing on free cash flow without debt, and then also new products and services. So if a company has new products and services, they would get those higher margin moats. They would get a durable competitive advantage potentially for a decade or more, many decades maybe. And the corporations are so short-term oriented, a lot of them are not focusing on any of that. It's turned into the point where they only care about beating the analyst numbers, which they've harassed these stock analysts on Wall Street, harass them to lower the numbers for revenue beats and earnings beats. Yeah, Apple has a lot of cash, but Apple also is not developing new products or services. Apple's betting on their moat. The problem is that Apple in China, Apple's market share is down a lot, and Apple had all their intellectual property stolen in China. So Apple, in order to make enormous profit margins, they manufactured their iPhones in China, but the trade-off was that yes, they were making super high margins selling the phones here in the US and Europe and elsewhere, but then all these Chinese tech companies like Huawei and others just stole all the IP, and there's dozens of iPhone knockoffs in China, and they've stolen all the IP, all of Apple's IP for free. So now Apple, for 8 to 10 years of profits from the iPhone, I think the iPhone's 8 years old now, something like that, and yes, they made an enormous amount of profits off that, but now their long-term advantage for that is gone, because now China has all that IP, all those Chinese companies have knocked it all off, and Apple's down a lot in market share in China. There's a lot of companies that have the exact same tech or very similar tech that have not paid Apple a dime, and Apple's very down on the market share. 12 years of iPhone. So the Apple executives who got the high salaries and high bonuses and the stock options, they would say it was worth it. But now Apple has to come up with new products and services because they're going to start losing market share globally with the iPhone, because there's so many competitors that have the exact same tech. And it doesn't look like Apple's doing a lot of innovation lately. They're gambling on their moat that people won't switch because they have their iTunes accounts and all the other stuff. Okay, looking at listener questions and comments. Thank you to my 100 plus Patreon account contributors, almost 150. If you want to do a research project, go back and look up debt to equity ratios and how they've changed for a lot of companies over the years. That's where the financialization has occurred. And most analysts don't even talk about this anymore. When I listen to conference calls for companies and they're talking about ratios or debt covenants and things like that, they're talking about debt to EBITDA and all that. They're talking about the mainstream conventional stuff. They don't even talk about debt to equity anymore, even though debt to equity, I think, is a very good, strict coverage ratio along with debt to cash flow and debt to free cash flow. Those should be the only ratios that the ratings agencies are using, and the ratings agencies are willfully compliant in all this. They're rubber stamping this stuff. And that's why you have $1 trillion in negative yielding besides what the central banks are doing. The ratings agencies won't downgrade all these companies because they know. And this is why, guys, you have all these emergency meetings. You've had 2 emergency meetings since Christmas Eve of 2018 that we know of. 2 emergency meetings about corporate bonds and the junk bond market here in the United States with Treasury Department, the Federal Reserve, the regulators, all those guys. Steve Mnuchin stupidly put out, he botched it, and put out a press release talking about the plunge protection team. So this is going to continue until you start to see the ratings agencies start to downgrade. But these debt to EBITDA coverage ratios are a joke. They're so laxed. If they were using stricter coverage ratios, all these companies would be fully insolvent already. Almost all of these companies would be fully insolvent. The fact that some of these large corporations that do have earnings, that do have free cash flow, but have loaded their balance sheet with debt, have real debt to equity ratios of 2 to 1 or more. So they have twice as much debt as they do equity, and they're not raising capital and they're not diluting yet. And sometimes they're even borrowing more to do share buybacks with debt or leverage buyouts is a total joke. The ratings agencies should be disbanded. There should be open competition. The fact that there's 3 ratings agencies with charters and the problems with the ratings agencies always happen is ridiculous. They're always complicit. It's been this way since the mortgage-backed securities, probably even before that. You put this message, CHN, twice. China can crash the precious metal paper system by offering, say, $2,000 an ounce gold. I totally disagree. Are you familiar with what happened to the Hunt brothers? So the U.S. government, the Treasury Department, the Federal Reserve, the CME Group could just cancel the long contracts. They could say national security issues. They could say national security issues, or that the Chinese government violated the legal position limits on the long side. They could cash settle. They could say it was national security, or they could just cancel the contracts altogether, saying that they violated position limits. So they can't crash the paper metals markets like that. Totally wrong. The rules were put in place, the rules were changed by the CME Group and others, and the COMEX, while the Hunt brothers were accumulating all those silver futures, long silver futures contracts. And the only two long futures contracts for commodities that have the strict position limits that you're risking massive fines, lawsuits, and time in prison for being over the position limit are gold and silver without an exemption. The banks could get an exemption, but I don't think the U.S. government is likely to allow that, even if the Chinese government has hired the Wall Street banks. Most likely the U.S. government would step in then. Go listen to the recent interview that David McAlvany did with his dad, Don McAlvany, and all the manipulation games that the U.S. federal government has been doing in the gold and silver paper market since the 1970s, since gold was legal again for American citizens to own. The stories of Don McAlvany talking about that is worth listening to. This is an interesting question. Do I think the Fed will supply currency swaps to China to prevent China from collapsing? If China goes down, that could be the trigger event the Fed dreads. I don't think the Fed will do that for free. I think China would have to concede something. It would have to be, the US would have a lot of leverage in that instance, and China would have to concede something important. I'm not sure exactly what that would be, but China would have to concede something to get those currency swaps. And this is why, go and listen to the interview that Real Vision TV just put out with Christopher Balding, and he's talking about how China does not want to use nearly as much dollar reserves to go buy iron ore and other base metal commodities. That China wants to focus only on mining, even at a loss, not at a profit. Go and mining iron ore and other base metals inside China. So they would rather use RMB, their own RMB they can print, to mine inside their own country, even at a massive loss. China does not, a lot of people aren't aware of this, China does not mine their gold inside their own country at a profit. It is not for profit. I've heard that the gold mining inside China, some of it costs over $2,000 an ounce to mine that gold. But China does not have to use dollars then to mine that gold, to pay for that gold or mine that gold. Ancient Paint asks, do I have any evidence that ratings agencies are being harassed? Yes, I do. Danielle DiMartino Booth has talked about this for almost a year now. She's been speaking to people who work in the ratings agencies, whistleblowers, and people who just retired from the ratings agencies, and they've confirmed this. The amount of pressure, sometimes it's daily, sometimes it's many times a day, that people inside the ratings agencies are being pressured by the executives of these large corporations, the chief financial officers and others, to not downgrade. So all the most rosy, all the most bullish assumptions for a buyout deal, a leveraged buyout deal for an acquisition that is quote-unquote accretive, that is adding positive cash flow and earnings, all those assumptions are included. So no, I'm not making this up. Danielle DiMartino Booth is very well respected. She's on TV all the time, and she's very well respected in the industry, and she's been talking about this for a while now. I think Real Vision TV is worth the money for the subscription, for the interview subscription. Thank you for the other super chat. Currency swaps. So, every country cannot issue currency swaps. Normally what happens with currency swaps is it's a creditor nation or it's the country that's the world reserve currency. So the two main country issuers of currency swaps right now, Lorky, are the U.S. and China. So the central bank of the U.S. and the central bank of China will talk to another country normally it's if the other country is in trouble. And so the other country, their central bank or government or Treasury Department will call up the U.S. Federal Reserve, and they will say, we're in trouble. We need emergency credit lines. We need a currency swap. And so what happened, the best example of this was the Ron Paul one-time partial audit we got in 2011, the Government Accountability Audit. And we found out that the Federal Reserve, during the 2008 and 2009 financial crisis, the Federal Reserve gave out $16 trillion interest-free loans and emergency currency swaps to foreign governments, foreign central banks, foreign corporations, even multinational corporations. And what happens in a currency swap is normally for another country to get dollars or another corporation in another country to get dollars. Let's just use Japan. So Toyota or Sony or Honda would have to manufacture more cars. In the case of Toyota, cars or SUVs or trucks. For Honda or Toyota, Sony would have to sell more PlayStations or other items to earn more dollars. And with the currency swaps, instead of corporations having to work hard to earn more dollars, what just happens then is the Federal Reserve can create trillions of dollars if it wants out of thin air, and then technically with a swap, they say it's not a loan, and a lot of these central banks don't report it on their balance sheets, and the Japanese central bank, the Bank of Japan, would print off the equivalent of $1 trillion in Japanese yen, and the Federal Reserve would credit the Bank of Japan with $1 trillion, and they would just swap the currencies. It's not a fake chart. It's from Jim Bianco Research. I'll put a link in the information and description section to the article. So with the currency swaps then, the Bank of Japan gets the dollars. They didn't have to earn the dollars, or corporations didn't have to produce more goods or services to earn the dollars. They just got the dollars because the Fed gave them the dollars. The Fed does not need the Japanese yen, so basically it's an interest-free loan, and the Fed can just technically just cancel out the debt if it wants. They can cancel out the loan on the terms if it wants. So the U.S. taxpayer and people holding dollars just lost a bunch of purchasing power because the Federal Reserve decided it wanted to maintain the system, and that benefits people. The Fed decided unilaterally without congressional approval or voter approval or anything. The Fed decided that they were going to maintain the financial system and that benefits us. And they're just giving out $1 trillion interest-free bailout money. Backdoor QE, covert quantitative easing, or backdoor quantitative easing. Currency swaps. And the Federal Reserve, actually, there was a speech. My friend James sent me this. GATA, Gold Antitrust Action Committee. There was a speech, I think at the end of 2018, there was a speech from a New York Federal Reserve Bank president talking about how the Fed has these swap lines open and is focused on bailouts and maintaining the system. So they're not even really hiding this stuff as much anymore. You can search on the GATA website for that article. They even, on the Bank of International Settlement website, it was at a Bank of International Settlement event, like a gala, and the New York Federal Reserve Bank president, they even put the whole speech on the website. No, currency swaps are not a way to manipulate exchange rates. Currency swaps are a backdoor bailout. So if a country like, let's say the European banks get in trouble, or European government bonds get in trouble, or the European Central Bank or the German government cannot save Deutsche Bank, the Federal Reserve then, and they've been doing this according to my source that I got from a high-level IMF meeting in 2014, that the Federal Reserve would just open up trillions of dollars in currency swap lines with the European Central Bank. It is not to manipulate exchange rates. It is to save banks normally, or corporations, or government bonds, to maintain the status quo at any cost, to delay a massive collapse. Now, currency swaps are covert QE, backdoor QE. There is no independent audits. Albert says he was in Hong Kong and nobody buys Apple. And so Apple had the lead for the iPhone for many, many years. And this is the trade-off that Apple did by deciding to manufacture in China. Now everyone has an intellectual property. All these companies do that didn't pay Apple. This is not financial advice. I would not go out and short the shares of Apple. But at some point in the future, what Apple's doing, unless they come up with new products and services, they will have a big problem. Currency swaps, Lorky, are a way for central banks like the People's Bank of China also does smaller currency swaps. Normally China does them to like Venezuela or African countries or Latin American countries, and it's a couple billion or 10 billion or 20 billion, and it's in exchange the country gets a bailout. So like Venezuela would get currency swaps from the People's Bank of China, but then Venezuela would have to give China more long-term oil contracts or mineral concessions or port access or things like that, or guaranteed agricultural production. And Venezuela doesn't want the RMB. Venezuela, what happens then with the swaps is Venezuela is dumping the Chinese currency immediately then onto the open market, on the offshore market and the Forex market, and then they're getting dollars. So they can say all they want about how they want out of the dollar, and once they get the currency swap money from China, the RMB, they're dumping it, and then China, the People's Bank of China, then has to use their dollar reserves to rebuy the RMB so their exchange rate isn't affected. Lorky, the only way we found out about the currency swaps at all was because of the one-time partial Ron Paul one-time partial audit that the Government Accountability GAO office did in 2011. That's why the Fed does not want to be audited. That's why the Federal Reserve's lawyers have said they will never allow even one more partial audit ever again. Oh, thank you for the super chat, Penguin. So, if I could summarize everything, I think I've covered pretty much everything here pretty well. That these negative interest rates, the lower the central banks manipulate to zero interest rate policy or NIRP, the more these large corporations will do financial engineering, and the more debt and credit these guys are using with the help of the ratings agencies who won't downgrade them until it's way too late to hang themselves with. And you don't see the problems with a lot of these large corporations in the price to earnings ratios. You see the problems in their debt to equity ratios, and you have to go back and compare the past debt to equity ratios. And that's where the rot is being done. And eventually, if these corporations want to survive, they may have to do reverse stock splits. They may have to do massive share dilution. They may have to do asset sales at fire sale prices. But these corporations, what they're trying to do, especially when their revenues are in jeopardy of falling, is they're doing shrinkflation. So the consumer then, if it's a consumer company that's a large company like Campbell Soup or another, or Kellogg's, that has a lot of debt, and these companies then, to maintain their margins, to maintain their revenue levels, because they're not growing their revenue, even if they do leverage buyouts still, their revenues tend to not grow, which means that they're losing revenues in different places. And that's why the prices on these consumer items like food, consumer staples, others are going up. And this is why Netflix is raising their prices. I believe Netflix, what used to be $7 a month? Didn't Netflix used to be $7 a month, and now it's what, $10 or $11? It's, I think, $11 a month. And the reason for that is Netflix has been growing, getting all their content with debt. And the only way Netflix can pay this back is they have to keep raising prices. This is a major part of their business model now. And you won't hear analysts talk about this because eventually, if Netflix keeps raising prices, the average marginal consumer of Netflix, and this is marginal, not every consumer of not every subscriber of Netflix, loyal people will stick around, and price increases for some people aren't going to bother them. But the marginal consumer of Netflix content, who eventually, if the price goes, let's say from $7 per month, someone who started off with Netflix, if someone goes from $7 per month and Netflix goes to, let's say, $15 or $18 per month, they will say, you know what? Disney now has Disney Plus at $7 or $8 per month. There's Hulu. There's Amazon has theirs. So there's other competition. So whereas there was not competition really when Netflix got started, people were laughing at them for streaming and a lot of the stuff they were trying to do. They were a market leader in this, but now there's competition coming. And if Netflix keeps raising prices because they're either not only do they have more debt, but they're also competing with Disney's new streaming service, Amazon's streaming service, Hulu, which Disney now owns as part of that Fox acquisition, the Fox Entertainment acquisition. And that's when Netflix could get in trouble in the future. And Netflix stock has started to crater a little bit. It's dropped quite a bit. And that was because their subscriber growth did not happen. And if they continue to not grow subscriber growth, people are going to start to get worried about the debt. But Netflix is going to probably, in my opinion, not financial advice, keep raising prices. But the marginal consumer of Netflix's content will say enough, and they will switch. They will either, because remember, the cable companies thought that they had a monopoly on us, and how many people canceled all their cable subscriptions? Because the cable companies just charge ridiculous prices. The price just keeps going up. Albert says, negative interest environment, not good for banks, but good for gold mines. I disagree. It's not good for gold mines at all. It might be good for the gold price, but the gold miners cannot raise capital right now. I talked about this last night. Go and listen to last night's stream. Very few gold miners are able to raise capital. Some of them can raise a small amount, but the large amounts of capital, none of the gold miners have raised any yet. And some of these miners, guys, for the last like 5 or 6 years, some of these miners have paid, some of the capital they're paying at is above 13% interest rates. So Sprott Inc., which is a company, full disclosure, not financial advice, just my opinion. I have investment in Sprott Inc. That's the parent company of Sprott. And they have a resource lending business, and they charge mining companies very high interest rates to borrow from them and build mines. And they make big returns on that. They have very good spreads. They charge mining companies very high interest rates to borrow because mining companies do not have a lot of available sources of capital right now. Yeah, I see a lot of I see a lot of problems with Netflix due to competition and higher content costs and debt on their balance sheet and slowing subscriber growth. I see a lot of problems for Netflix. I'm not saying it's going to crash, but there is a lot more competition for Netflix. Lord Baboon, most of my thoughts on London Gold. London Gold has the best new high-grade gold deposit that's being built. It's about 80% done with construction. Sandstorm Gold has a royalty on it. A small royalty on it. The geologists really like that land package. So I think the potential there, not financial advice, just my opinion, the Fruta del Norte mine, that's a really good gold mine. It has average over 8 grams per ton. So that's the grades at that gold mine are over 6-fold higher than the grades at every other gold mine. The average grades at gold mines now is about 1 gram to 1.2 grams per ton. And Lundin's deposit there at Fruta del Norte has about 8.7 grams per ton, average gold grades. So a new mine could always have problems with it's either not on time or not on budget. So far, the mine is on time and is on budget. So the geology looks really good for that mine. And so far, the mine is on time and on budget, which means if that continues, the mine will be generating really solid operating cash flow. So if gold price goes higher and that mine comes on time and on budget, the stock hypothetically for Lundin Gold should go up a lot. That's if management executes the mine being built on time and on budget. The problem with Lundin Gold is that they only have one mine. So that means they have had to bet the whole company. And yes, it's backed by the billionaire resource investor Lundin family, but they still have to bet the whole company on the one mine. So if there is problems, if there, let's say the Ecuadorian government decides to change the tax laws, they did that years ago, but now it seems to, Ecuador seems to be very pro-mining now. There's been a lot of investments into Ecuador by a lot of different mining companies, over a dozen big mining companies in the last like 4 or 5 years. So Ecuador seems to be very pro-mining now. A lot of, seems to have a lot of good geological, a lot of good geological upside, a lot of mine potential there. One of the best new countries for mining on the planet. Yeah, I really like that mine, but I don't own Lundin Gold shares. I have exposure to it through Sandstorm Gold. So that, to me, I get exposure to that really quality gold mine from Sandstorm Gold on their royalty. What's wrong with debt to EBITDA? So EBITDA is earnings before interest, taxes, depreciation, and amortization. It's not really earnings. Tarkinis, it's not really earnings. So it's a very laxed debt covenant ratio. So these credit ratings agencies and these analysts covering these large cap stocks from Wall Street and others, they're only looking at debt to EBITDA. If they were using more strict leverage ratios and more strict debt covenant ratios, a lot of these companies would be in big trouble already. They should have gotten their credit rating downgraded. So EBITDA, I don't like EBITDA. I don't look at EBITDA at all. When I look at a company, when I spend time researching through the company's financial statements, I don't care about EBITDA at all. It's about operating cash flow and free cash flow and margins in the income statement. There's so many, it's ridiculous how important EBITDA has become. And then on top of that, I didn't mention this earlier, you have all these financial statements, guys, that are non-GAAP. So many things are non-GAAP now, non-generally accepted accounting principles. So all these controls, Francine McKenna talks about this, all the accounting controls are very lax. She writes articles about this all the time in her Market Watch column, how all these big four accounting firms have found that all these large corporations have very lax accounting controls. It's a mess. It's not as bad as Chinese accounting, but it's bad. Yeah, so I wouldn't even look, Tarkinis, I wouldn't even look. You're normally a super chat person, so thank you for that. I wouldn't even look at EBITDA. If you're looking at a company, don't look at it. It doesn't matter. Operating cash flow, free cash flow, and the margins. You're looking to see if the margins are maintained in the income statement, if the margins are increasing, or if the margins are contracting. Albert says always look at cash flow, but yeah, the Wall Street, you should always look at cash flow and free cash flow and margins, but Wall Street for the earnings power of the business, but Wall Street, if you listen to a conference call, Albert, and you read research from Wall Street, all they talk about is EBITDA now. It's ridiculous. They mention EBITDA on the conference call so much now. It's ridiculous. On so many conference calls so many times now, it's ridiculous. And it's just, and a lot of the stuff is non-GAAP. A lot of the stuff in the financial statements is non-GAAP. Even I told you about General Electric. They have SEC filings here, and they're even saying they even sent to the SEC unaudited stuff. It's just amazing. It's just amazing how crazy everything's getting. Okay, guys, well, my voice is going. I need to take a break. Bye for now.